Hi, Jimmy. Let's talk about the latest inflation numbers in Canada for the month of September. Those headline numbers easing, coming in below expectations and less than what we saw in August. Take us through those numbers.
That's right. So we see ourselves with inflation not only at target, but I guess crashing through the target. 1.6% is now pretty low. And what we see in the monthly details, of course, a lot of this was driven by energy, gasoline in particular. So we had that dip in oil prices in September. Got a little bit of volatility in October, so that might change. But we also saw airfares, and that's been a persistent theme so far this year. A lot of weakness there, and we know Canadians have been tightening their belts on that front. So you're continuing to see as well the impact of strict monetary policy and a consumer that continues to save more and spend less. And that continues to bring down the non-energy components of inflation. And that's why you have core measures as well being well behaved at this point in time.
Let's dive into that a little bit more. Take us through food, shelter. What does that look like?
Well, food has been in a range within the 2 to 3% area for quite some time. So we're well off the double-digit levels that cause many people to panic. Now, of course, the level of prices remains high for a lot of people, but at least the pace of increase is pretty steady in that tight range. When it comes to shelter, you're seeing some improvement. So, rent is still pretty high at 8.2%, but it's come down from 8.9% on a year-over-year basis. And you're seeing the whole shelter category as well decelerate more and more because we know that mortgage interest costs are also decelerating on a year-over-year basis. In fact, they were at 16%, and the peak was 30%. So they're kind of halfway towards where we want them to be. So, I mean, this it's a report that has a lot of encouraging dynamics, and you find yourselves at 1.6% inflation and 4.25% interest rates. So I think it's pretty logical what the Bank of Canada needs to do.
Let's talk about what the Bank of Canada needs to do and what they may do in the upcoming meeting. Before we go there, though, with respect to that inflation outlook, um, is it pretty much in line with what you've expected? Has it exceeded expectations? What does your forecast look like?
So we were below the consensus. We had the 1.7%, and it managed to come in even below that. Now, what's interesting is that the Bank of Canada was expecting 2.3% on average for the third quarter. And as it turns out, it's 2%. So that's quite a significant departure. In fact, the Bank of Canada was expecting 2% inflation to return only by the second half of 2025. So we're about 1 year ahead of schedule. So on that front, I think the Bank of Canada as well has been surprised by what they've seen from inflation in the last few readings.
Canada's central bank making a policy announcement near the end of October. Let's talk about what you think they're going to do. So far, it's been slow and steady, 25 basis points at pretty much every meeting. What will the bank do at the next meeting? What is the expectation as you see it, Jimmy?
Well, we've been of the view that the Bank of Canada would cut by 50 basis points. We took that view on September 17, right before the Fed even surprised with its 50 basis point rate cut. And we held that view at the time because of inflation, but also what we were seeing in terms of the labor market. Now, last Friday, we had an apparently strong job market report, but you could poke a few holes in that report. And really, the takeaway is that this was a disinflationary report. We saw wage growth decelerate, and we see more slack in the labor market as population growth remains strong. So I don't think the Bank of Canada was deterred by that report, and the Business Outlook survey was pretty dovish as well. Now comes this report, which is, I think, the final coffin that seals the deal for a 50 basis point rate cut. And I think the market is pretty much moved in that direction.
Governor Tiff Macklem has suggested recently that larger cuts are on the table should the economy slow. What does that mean then for the balance of the year? We've got another meeting before the year is out.
Right. Well, we think going forward, the Bank of Canada will likely proceed at the 25 basis point increments. Now, of course, this will be contingent on how the economy performs, as you mentioned. Already for the third quarter, we're tracking 1.2%. The Bank of Canada was forecasting 2.8%, so that's a significant miss from the Bank of Canada's expectations. We'll have to see what happens in the fourth quarter if we continue to see that kind of weakness and very significant labor market slack. That could prompt another 50 basis point rate cut. This is not our central scenario at this time, but certainly a risk out there. I think the bottom line is that there's more of an urgency now to return interest rates to a neutral setting because we're seeing some concerning signs in the economy and the labor market.